So, Mike, I mean, both your funds that you just talked about are doing very, very well. In fact, they're beating the market, right? And I'm curious, whose money is in these funds, right? Are these real money accounts, institutional money, or how much of it is retail money? Because J.P. Morgan just did some research and discovered that, you know, the market broadly is up, 25% so far this year. The average retail investor is only up about 3.7%. I'm wondering, what are they doing wrong? Or conversely, if it is retail money in your funds, what are you doing right?
They should have been in our fund. But I digress. No, I think one of the bigger problems has been that people, you know, were a little bit late. A lot of liquidity was sitting on the sidelines, invested in money market funds and cash vehicles. And a lot of people didn't trust the market. And so they were a little late to the game. And then the market for a while was strictly, you know, 10 tech stocks. And if you weren't in those stocks, it was probably too late to buy them. And so you were kind of on the sidelines. Now, more recently, the market has broadened out. A lot more stocks are outperforming. And so that's better for investors to come in. And I think that's one reason we're seeing more money come into the equity markets, generally speaking. You know, so to me, that's the main driver. It's timing. And it's always tough as an investor when you're not in it every day. It's tough to gauge the right timing and get it right. Even professionals have difficulty doing that, including us. And so we advocate sort of a fully invested approach where you're not trying to time everything day to day to day, but you're invested and you just sort of sit tight on your investments and let them work for you.
We got Nvidia reporting later on this week, and it really encapsulates the concentration risk in the equity market, which stands at a record high. If you look at Nvidia, how are you approaching that name?
Well, we've been an owner, and so obviously we've benefited from it. We've trimmed it a little along the way, but we still have, you know, a reasonable position in it. And we believe in it long term. I think when you get something like this, you do have to be cautious as to, you know, every quarter they're outperforming, backlog demand is great. There, you know, multiple business sectors are running well. It sounds great, but you do have to wonder how long it will run at those levels and then what happens. On the other hand, they truly are a market leader in an area that is growing substantially and has a lot of energy to it. So it's one that, you know, there's a reason it's going up. And so you do want to look at things like customer concentration, economic conditions, backlog, inventory builds, et cetera. And so, you know, as investors, that's what we're cognizant of doing. And Nvidia is not the only one that's run a little bit in the chip sector, but certainly it's the one everybody knows. So we're watching it very closely for signs that growth may slow down going forward, or other factors that could result in a correction of the stock price. But long term, we still like it. It's one of our bigger holdings.